Good morning. This is Larry McMillan with a stock market update on Monday, February 13th. So the stock market has had some trouble continuing its upside breakout over 4,100 last week and fell back below 4,100. Normally that would be a pretty negative development, but not much has really transpired in that way either. So the market seems to be stuck in this area. Perhaps it's awaiting the CPI report tomorrow, which could be a Valentine's Day present or not, depending how you look at it. And meanwhile, S&P has resistance now at 4,200, which was the highs of early February, and support really is down at 3,900. There might be some intermediate support areas above that. So right now it seemed like SPX was going to break down, but that hasn't really transpired. And so both camps are, I think, probably a little bit frustrated, the bulls and the bears, that is. Equity-only put-call ratios remain on buy signals. They've dropped a lot, so they're no longer in oversold territory, but they haven't come close yet to generating sell signals, so they're still positive. Breadth, however, has deteriorated badly and has given some, our breadth oscillators have given sell signals, both of them. So usually we want to see 2 days of negative breadth to confirm that, and that has been attained. So if the market breaks below last week's lows, we would act on that breadth oscillator. Otherwise, probably just going to watch that signal as a potential sell and not necessarily a sell without confirmation. New highs versus new lows still remains a positive indicator. New highs are not as robust as they were, but they're still outnumbering new lows quite easily, and that's on the New York Stock Exchange. VIX itself has tried to rise as the market has fallen back from 4,200. And if VIX were to return to spiking mode, that would be a short-term negative. Today, VIX would have to close above 2263 in order for that to happen. That doesn't seem too likely. The VIX trend, the trend of VIX buy signal that's in place right now is safe for now because VIX would have to close above its 200-day moving average at 2510 or so in order to terminate that signal, and that's really not in the cards at all. The construct of volatility derivatives remains mostly positive for stocks as well, although the short-term 9-day CBOE volatility index is elevated because of tomorrow's CPI report. It should fall back in line after that. So all in all, we don't have a trend evident right now. The bulls have failed by not being able to capitalize on the rise above 4,100. But the bears have failed too because they haven't taken advantage of what potentially was a false upside breakout. So we're trading our individual indicators as signals arise. And I encourage you to visit our website, take a look at our newsletters. Also take a look at the new feature we have on our website, which is a celebration of 50 years of option trading. The CBOE's birthday is coming up in April, and it will be 50 years old. And we're putting together a series of articles and interviews from people who were around near or at the beginning of listed option trading. Meanwhile, have a great week trading.